Let's begin with the big issue. Investors split over the outlook for the U.S. economy.
We know that there's a slowdown.
Growth slowdown in the U.S.
The economy's, slowed down, but it's still in pretty good shape.
Fundamentally, the U.S. economy, I don't think is threatened by recession.
If you took the U.S. economy, came down from Mars and said, what's wrong with this economy? The answer would be nothing.
The U.S. economy has not slowed down dramatically, not in terms of private demand.
The slowdown in the U.S. economy would be a bit more severe than the market expectations.
I don't really see strong reasons to expect the labor market in the U.S. to materially break down over the next 6 to 12 months.
Yes, the consumer side of things and the labor market side of things is looking quite good, but the manufacturing sector is under a lot of pressure.
There's clearly a pretty significant dislocation between the industrial economy and the consumer economy.
Yes, we should be concerned about downside risk.
Downside risk to the economy.
But let's not panic here.
Who's panicking? The key question. Can U.S. consumers outweigh the weakness elsewhere? Joining me around the table to discuss, Roland of John Hancock Investment Management, Jonathan Golub of Credit Suisse, and Jim Caron of Morgan Stanley Investment Management. So, Jim, let's begin with you. It is consumption versus investment. What's the story for you?
Oh, I think it's consumption. Look, this is a quarter that we were supposed to have weakness, right? Think of what happened with trade, with China, and everything else. We had a very strong retail sales number. This is telling us something. There is some upside risk to the economy. The other thing that I'll say, too, is that look at where PMIs were coming in. PMIs very, very weak around the world, and now we're getting a 2% number plus for the U.S. second quarter. I think that if there is an inventory rebuild in the second half, there could be upside surprise.
Emily, your take?
Sure. I think one thing we need to remember is that GDP is a very much backward-looking figure, right? And one of the things that we like to look at is the Conference Board's leading economic indicators index. That came in at a pretty paltry 1.6% this month, year over year. That's down from 7%. So we do see a further deceleration in the U.S. economy here going forward.
What do you think, John?
We're getting caught up in the last print. Potential U.S. GDP is less than 2%. We're running right now at about 2.5%. We are going to decelerate back towards a trend, and we were talking about, John, beforehand. Europe is weak because that's where potential GDP is in Europe. It's probably 1% or maybe less. And ultimately, we're moving back towards a lousy trend, and the most recent trend data point is just that.
Emily, could it really be worse than what John just described?
I think it could. If we, again, go back to the LEI, it could be negative by the end of the year. And historically, that tells us that a recession is somewhere around 3 to 6 months away from that. So we think that now is the time to prepare portfolios and get a little bit more defensive in anticipation of that.
What do you say, Jim?
Oh, look, I think that's a fair point. Going forward, if we look at some of the global risk factors, they're still out there. But what we have to also remember is that central bank policy is still very, very supportive here. Rates are probably going down in the U.S. So to the extent that a lot of this is anticipated, some of that could be offset.